Hello, this is Chuck Carnevale, co-founder of FastGraphs. In this video, we're going to look at high-growth companies that pay a dividend, companies that grow faster than 15% and have modest dividend yields but increase those dividends very quickly. Our first example, we'll look at Ross Stores, a fast-growing apparel retailer. There's some very interesting things that this particular graph reveals. If you look over to the right in the Fast Facts, you'll see that operating earnings growth since 1999 has averaged 17.2%. However, a quick look at this graph will see that it looks like growth was flatter up to 2008 and then accelerated, which is very unusual given the recession. So one of the tricks of fast graphs is you can lengthen or shorten the graphs appropriately. Here we're going to go ahead and run a 5-year fast graphs on Ross Stores in order to illustrate what's happened to its growth rate. By looking at Ross Stores since calendar 2009, we see that growth has actually accelerated and the company has averaged over 26%, almost 27% since calendar year 2009. But this is why the normal PE ratio is an important aspect. We also see that the market has really only valued this company at something around 14.5 times earnings. In other words, the normal PE ratio has been about 14.5. But what's even more interesting, if we go down and look at the performance, we see that since the beginning of calendar year 2009 or the end of calendar year 2008, a $1,000 investment would have grown to $3,782, averaging 37.7% compounded, which is highly correlated with the 27% earnings growth that it achieved, enhanced by a little bit of slight overvaluation based on its normal PE. However, I also want to point out that the company has paid a dividend, and they've increased their dividend every year during this period from 2009 to year-end last year. And so the dividend actually increases the rate of return by almost a full percentage point annualized. With our second example, we look at Oracle, and you can see Oracle has had very above average earnings growth of 18.5%. So the PE ratio of this orange line is 18.5 in this example. And notice what happened during the irrational exuberant period or the tech bubble when the stock price completely disconnected from the orange line, but how within a matter of a year or two it immediately came back, and then how price tracked earnings until once again we see a lot of tech stocks trading at a discount. But notice how Oracle's earnings have continued to grow even though their price is now currently low. We also see the initiation of a dividend here. That's why we express it with the light blue shaded area stacked on top. We can see that Oracle started paying a dividend in calendar year 2008, but that dividend has grown every year. But notice how low their payout ratio is. Currently in the 12 to 15%, and you can see the low payout ratio by examining the stock here. Nevertheless, the earnings and price correlation of both of these stocks based on a PEG ratio or P equals growth rate PE ratio is very compelling and highly correlated. The other thing to notice is that the earnings growth rate, the 18.5%, also correlates to the company's track record over time, discounted for undervaluation in this particular case.